Hello, I'm Simon Edelsten from Goshawk Asset Management. I thought I'd do a quick update on market conditions and what's been going on in global equities over the last couple of months. So a while ago, we felt that the AI enthusiasm may be getting a little bit out of control. There were a couple of reasons for that. Firstly, some of the claims from the people who are building AI engines and making claims for artificial general intelligence and massive changes to the economy, a lot of those claims are perfectly reasonable, but some of them are struck us as being certainly ahead of proof, ahead of reality, and starting to feel like hype. And to a great extent, those feelings that hype was being sold came to a head around the time of the SpaceX IPO, where we felt that the valuation of the shares at IPO was very extreme and based on some claims about building future businesses. We're not saying that we know that they won't happen. Data centers in space on massive scale making massive returns. We just think that risk adjusted, we wouldn't be prepared to put our money on them happening at the scale that would be necessary to justify that share price. So as ever, or the price they wanted for the IPO. So as ever, we do look at everything that comes along. We listen to people's arguments. We're interested in growth stories. We're interested in exciting stories. But then we always try to relate things back to what we call old-fashioned valuation criteria. And that particular opportunity certainly struck us as not meeting our criteria for investment by quite a large margin. And lo and behold, that moment also seems to have rung a bit of a bell for the market. So there had been doubts about the AI companies before, OpenAI in particular, which was everyone's poster child a year ago, seemed to have been overtaken by Anthropic, and particularly the Anthropic Claude programs for building your own AI agents, which are certainly proving eye-opening and very popular. But even there, the cost of building these task replacement agents had been exceeding the cost of doing the task in the old way. Principally because the cost of the computing behind the AI kept going up. A combination of energy prices rocketing up, partly because of the war in the Middle East, but also because the components for making the compute have shot up in price, particularly memory chip prices, but also processor prices. So building the data centers which are going to power all this new AI has also proved to be much more expensive and much delayed compared with the plans of the other year. Now, more expensive means that your margin's being eaten into unless the customers are lining up to pay whatever it takes to get that extra productivity. And the evidence at the moment seems to be that they're not, that many companies are rather surprised and shocked on how little extra productivity they're getting for how much it's costing to do the AI. And so we're now bumping into a lot of companies outside the AI area saying, hang on a minute, my head of IT said we can get rid of these work streams, we can get rid of these people. If only I could go off and do an AI project and get this sort of pretty basic level clerical work if I can get an AI agent to do it. Now, not everyone, some people are finding that they are replacing some very basic work very cheaply and very efficiently, particularly in fairly repetitive tasks like basic computer coding, also some diagnostics. Clearly, medical diagnostics have adopted AI very quickly indeed. So there are areas where the extra productivity is already proven. Some legal firms are finding that this is working for them very well on the basic stuff, not the value-added stuff. And so it feels like one of those moments, a bit like when when Word first came in and we didn't need a typing pool anymore, where some basic repetitive work that was done by a lot of people can then be replaced by the rest of us. The rest of us had to learn to type in order to, with 2 fingers in my case, in order to not need a secretary and a typing pool to write my letters. And that, was probably a productivity improvement introduced by Word and everyone having word processing software in the mid-1990s. And so it feels like that sort of event, that AI will give another leg up in terms of some basic stuff that the AI agents will be able to do for us at relatively little effort and relatively little cost. But that's not the same as replacing whole jobs. So quite often what happens is that the people who have the more value-added jobs, or even very slightly value-added jobs, just learn to use this AI, learn to use the new technology to make themselves more efficient in what they do, to make the duller parts of their work easier and quicker. But it doesn't mean that you replace a whole person with an AI agent. Even if you did, you're going to need people to look after those AI agents, and they're often the people who were doing the task before, because they know how to step in and make sure that the AI is doing it right, and also to step in and do their old job if the AI does it wrong. So the fear of mass employment turmoil here in people currently in employment is probably also something that's overstated, though no doubt question marks about what's going on here, unfortunately, are affecting companies' willingness to employ young people and train them up, because they don't know how many trainees they're going to need for the moment. But perhaps that will be a phenomenon which hopefully won't last too long. Anyhow, to get back to the main investment subject, the results of the AI that has been produced so far, except in a small number of sectors, has not been that impressive. We're now into year 3, perhaps, of this. People very often get excited by the first blast that they see of building an AI agent, but then they can end up getting very frustrated when the job is 80% done, 90% done, and it keeps costing more and more and more money to get slightly closer to the final point where the whole task can be done by AI. And then, frankly, they find quite often it won't do the last bit. You still need human intervention to do the last bit, or to check on the last bit. So again, getting the AI to a point where it replaces whole people, which is where it would be paid for with a lot of money by companies who want to improve their productivity, seems to be a moving target at the moment, and does not seem to be being delivered to people who had that plan in mind. So that's been a bit of a problem about how much money will be paid for all these AI applications as they're being built. Perhaps it's still early days, perhaps there'll be a step change later on, but quite often with technologies, the exciting bit is the early bit, where you go from not having something to, goodness me, this is exciting, I wonder how much we can do with it. And then the latter bit is where you're stepping closer and closer to the end game, but it seems like you're going down in sort of logarithmically smaller steps for the same amount of cost to try to get closer to your final goal, and sometimes we'll never quite get there. So that's been a problem for the AI story, and particularly for the valuations of the AI companies in America, such as OpenAI and Anthropic, both of whom hope to IPO, come to the market with trillion-dollar type valuations this year. That seems less likely now. Then the second thing is that there is plenty of AI out there. Some argue that it's cheap and nasty. Some argue that it's been built on copying stuff from America. I wouldn't like to try to venture any guesses about how it's happened. But for the world as a whole, Chinese AI is cheap, cheerful, and works, and is pretty effective. And so as value for money in building these agents becomes a bigger and bigger issue, particularly in terms of companies' budgets, where companies have gone off and said, fine, go and build an agent on Claude, go and build an agent with OpenAI. Oh goodness, you've just broken your budget and you haven't got 2/3 of the way there yet. The Chinese AI, therefore, is of considerable interest around the rest of the world, especially because of issues about political interference with the availability of American AI, particularly at the higher end, with the White House basically turning off access to Anthropic products a few weeks ago. And you can imagine that governments, which often set standards on this, just said, well, we obviously can't use American AI if it's only available when the Americans want us to have it, and when they don't want us to have it, they can just turn it off. Chinese AI, is that safer? Is that less likely to be turned off when you need it? I think it just goes to show that there won't necessarily only be two big American companies doing this stuff. There'll be other options. Unfortunately, at the moment, there doesn't seem to be very many European options, but not relying entirely on one source for this for these software functions would seem quite wise, to diversify routes. And if that means that you end up with 2 or 3 places you can access your AI, but all at reasonable cost, but it gives you options, even if it's not all top end, even if it's not all cutting edge, because not all tasks that you want to be done are cutting edge, then that might also seem like a sensible course of action. So it again, this is a certain size of pie of the potential revenues that are going to come to the AI companies. Those revenues seem to be likely to arrive later. They're slow coming. The amount of money now probably, it's going to look like it's terribly big, but that's because in the short term, because budgets are overshooting. But then there'll be a reaction coming through probably later this year, and budgets will be pulled back probably as people have another think about exactly what they're planning here. I'm talking here about non-technology companies all thinking about what they need to do to keep up with AI in their specific industries. What's their budget going to be for next year? So they'll probably pull back a little bit, wait and see what's going on, not worry that they'll fall behind on this, and make sure that they get value for money out of how they're spending their money here. So the Chinese challenge, deferred revenues, and so on and so forth. In the middle of all this is this $1 trillion data center build for the data centers which are going to host all these AI applications in the very long run. Now, the thing about building data centers is that almost certainly that computing power will be used for something at some point. Some of it may be AI, some of it may be old-fashioned cloud computing dressed up as AI. I mean, it's hard to tell the difference. And cloud computing itself needed more and more capacity as time went on. The interesting thing about this, though, and the worrying thing about this is how brilliant do you need to be to build a data center? And I'd argue not terribly brilliant. How specific are people about who they have doing their cloud computing? Cloud computing has been dominated by Azure, which is the Microsoft product, and AWS, which is the Amazon product, which is open source. And those two companies have rather dominated the space for years. But now Google is building a big business in cloud as well. And other companies like Meta and Elon Musk's businesses are also going to have compute that they can offer out as cloud. Now, one of the key things that we worry about the valuation of any investment when we assess it at Goshawk is, what are the barriers to entry? Well, what you're seeing here is that the barriers to entry in building data centers are not all that large. I mean, I'm not saying nothing, but they're not huge. Technically, it's not that difficult to do. It may be difficult to get in customers, convince customers you're the right place to host their cloud, that you're secure enough, that you're reliable enough, that your cloud won't switch off, won't have problems on stability or safety. But the barriers to entry themselves are just about having a lot of money. And I think that, because these data centers cost a lot of money. And I think that this is a mistake which quite often happens in the city, that people think, well, because it costs an enormous amount to do something, there's a high barrier to entry. For me, that is not a barrier to entry. It's a cost. if governments want to build big data centers, they will do it. We're seeing many of the countries in the Middle East, which have huge amounts of money, will be building very big data centers because they can see that this is something that they can afford to bankroll. It's even the same, by the way, with satellites, that people say, oh goodness, Starlink will be the only company which ever has satellites like this. Well, I mean, for me, that's baloney. Lots of people have put satellites up over the years. At the moment, Starlink is the most efficient company in putting satellites up because of their rocket technology and reusable parts for their rockets. But just the other week, somebody launched a rocket with some satellites out of New Zealand, who nobody had heard of, and they seem to get up into space with hopefully not bumping into all the other satellites that are up there. So Starlink is ahead of the game, but that doesn't mean to say that the barriers to entry in launching satellites are huge. It's just a lot of countries have stopped launching satellites. The French used to launch satellites quite frequently for European television and telephone companies with Ariane rockets 20 years ago now. But they couldn't make money out of it, so they stopped. But one could get back. It may take time, but it could well happen, and it's likely to happen if the returns are very high. That's how capitalism works. So again, just going back to the data centers, this $1 trillion investment going down at the moment, trillion and a bit, very heavily debt funded, which is unusual in the technology space. These technology stocks were very highly rated because they were highly cash generative. They're now in a phase of doing stuff which is enormously capital intensive, the opposite of the business model they used to have. And where the margin likely here, I feel, is at risk in the very long run. I'm not saying that the margins on data center or cloud computing will go down in the short term, but if there's too much capacity, or if the capacity takes a long time to come in and the revenues don't arrive, there is a little bit of build it and they will come going on here, which is always a risk to the valuation of shares. So just to pull all that together, there's now a concern in the market that the debt funding, in particular of data centers, is a worry. And if you put that at a macro scale, this is happening again at a time where bond investors are worried about backing any bond issuance because inflation is up. Again, principally because of oil prices being up because of what's going on in the Middle East. And then I'm afraid on top of that, recent speeches by central bankers, such as the new head of the Fed, have not convinced bond investors that inflation is going to be rigorously dealt with by raising interest rates. There is a feeling, I'm afraid, last week that the new head of the Fed is more concerned with being chummy with President Trump ahead of the midterm elections than he is to worry about inflation and doing his job, frankly, where the evidence is that most heads of the Fed would be putting up interest rates at the moment. Some people might say that about the Bank of England as well, because there is quite a bit of inflation in the system and it is stubborn. On top of that, the Japanese central bank is quite inclined to put up interest rates at the moment because you've had 2% inflation, which in Japan is an extraordinarily high level on the basis of the last 20 years, and interest rates there are only 1%. And so if they said that they wanted to put interest rates up, not least to protect the yen, that wouldn't have gone down very well with the Fed either. And so lo and behold, the Fed is now stepping in, buying up yen to protect the currency, perhaps to take the pressure off the Bank of Japan to put up rates, which would mean that there would be extra pressure on everyone else to put up their rates. So the worries in the technology sector that we keep an eye on, and the AI story that we keep an eye on as equity investors, also have a parallel in the bond market where bond yields are going up. That's generally, I'm afraid, a time where one wants to be more cautious, where one thinks that some of the very substantial gains we've made in equities over the last 2-3 years might have to be given back a little bit, just as we settle down, deal with a world where there's a bit more inflation around, where there's serious concerns about some debt funding in the system, a lot of which is hard to pin down because it's in the private debt world. And just, sit back, take stock, relax. It's not often that you get vlogs from people who run fund management companies saying, actually, I think this is probably a time to be a bit more cautious, but you can take it that at Goshawk, we will try to be more cautious over the next few weeks and months, and we'll try to make sure that whatever happens over the next 6 months, we're trying to protect capital as well as we can. And to be frank, outside the technology area, there are plenty of stocks which haven't really performed over the last 5 years and whose value for money is perfectly good and whose businesses are working out pretty well and growing quite healthily. They're just outside the main spotlight areas, and hopefully those sorts of stocks will enable us to produce decent investment returns even in a market with the challenges I've outlined today. So I hope that you found that interesting. As ever, any questions, any comments, our website is www.goshawkam.com. I'll be interested to hear from you. Thank you for listening. Goodbye.
The content of this video is provided for information purposes only and is not intended to be an offer or solicitation, nor is it intended to be investment advice. The funds run by Goshawk Asset Management may have positions in any of the stocks discussed, but their inclusion in this video should not be taken as a recommendation. Historical performance information is presented by way of example only, and this video may contain forward-looking information that is not purely historical in nature, with no representation made that the performance presented will be achieved and no guarantee that any forecast will come to pass. Reliance upon information in this video is at the sole discretion of the viewer. It is not intended to be relied on in making or refraining from making any specific investments or other decisions. Opinions expressed, whether specifically, in general, or both, on the performance of individual securities and in a wider economic context, represent our view at the time of preparation and are subject to change. We hope that's helpful.